Good morning from the Paretodesk, Wednesday, 6th of April. Today we are very happy to have Harry here in person. Welcome to Stockholm, Harry.
Thanks for having me.
We will talk about the stock markets because we saw that stocks fell yesterday after Fed taking an aggressive or a more hawkish take on inflation and rate hikes. What's your take on that?
Well, I think that's one of the big risks for equity markets at the moment is that inflation becomes out of control, inflation expectations become unanchored, and interest rates and bond yields and rates across the curve have to start moving up even more aggressively than they have. And then that puts pressure, particularly on the tech and growth parts of the equity market. So I think that's a key risk at the moment. And I suspect, though, what we're talking about is a phase of rotation out of tech and into others rather than a bear market.
Mm-hmm. So could we just simplify what red lights and what green lights do you see for stock markets?
Yeah, well, in terms of red lights and things to worry about, inflation is clearly one of them. I mean, there's always the risk that COVID deteriorates, we get another strain, potentially that impacts growth again. I suspect that's probably a low probability outcome. And we've got the Russia-Ukraine situation bubbling away in the background. And it's possible that, that situation deteriorates and we have another big increase in energy prices, particularly oil and gas for Europe. I mean, the gas price in the US has stayed pretty low and stable. So that's a potential challenge. China is also a potential risk. Growth slowed down very significantly. Will the economy stabilize and begin to reaccelerate later this year or not? I think that's a big question mark and a big risk for markets. So those, I think, are the things to worry about.
Yes, so now you have to give us something to look forward to, or some green lights instead.
Yeah, well, I mean, I think, if you look at the US economy, it's structurally in very good shape. Households have got a lot of spare cash in the bank. We think they've got spare cash something to the tune of about 20% of GDP, which is enormous spending firepower. Spending growth is very strong. We're seeing a re-leveraging of the household sector. If we look at home equity withdrawal, money is still very cheap. The Fed has only really just started raising rates. If you look at real interest rates, they're -6%. So they're deeply negative. All of that, of course, is encouraging and positive for the economic and earnings outlook. And of course, therefore, the uptrend in the equity market.
So which side are you on?
Well, I'm leaning towards the bullish side. I think we're still quite early in the cycle. Of course, the labour market looks like it's late cycle, but you look more broadly at the rest of the US economy and it looks pretty early cycle. Money's still cheap. Companies are throwing off free cash. They've got lots of, the cash levels are still very high. As I say, the household sector looks good. There's a very strong wealth effect from rising house prices. As I say, interest rates are super deeply negative. So I don't see a recession. I mean, we've had the curve inversion, which is people are worrying about that. But I don't think we need to worry too much. It's often a very early signal and it's not confirmed by lots of other things as well. So I think we've got further to run in this equity bull market. There's a lot of bearishness around. People are very worried. That's usually a good time to own equities. And
you talked about tech stocks and the rotations from growth to value. Haven't we already seen that?
Yeah.
Do you think it will continue, or do you think it will be rotating back?
Yeah, I think that's the key theme for this economic cycle and for this bull market in equities, which is one of higher and rising bond yields, which drives rotation out of growth and into the value and cyclically sensitive parts of the market. So you're absolutely right. It's already been happening. I think there's much more of it to come. And the template for thinking about this was probably the early noughties economic expansion from around 2000 to 2007. Bond yields, you'll remember, really it was 2003. We had the low in bond yields. They then trended up to 2007. We had outperformance of cyclical parts of the global equity market. I think that's what we're going to see again for the next few years.
And last but not least, I have to ask you about the rate hikes. How many are priced in now?
Well, we've got about 8 or 9 hikes priced in for this year. We've got a couple more priced in for next year. And yeah, I think the Fed are going to deliver on those.
You think so?
Yeah, I think they will. And inflation, it seems like the underlying trend in inflation is very poor. If you look at median inflation, it's been deteriorating very significantly. The breadth of inflation across the CPI subcomponents has been increasing. as I said earlier, inflation expectations are going up very significantly, and I think the Fed want to fight this, get on top of it. So yeah, I think they probably will deliver on all those hikes.
But still 9 hikes and you are still bullish.
Well, the US economy is structurally very strong. The labour market's strong. I think it can absorb a lot of this. What happens next year, we'll have to see. And we'll have to see how strong the US economy is looking by the end of the year and going into next year. But at the moment, it looks like it can absorb those hikes.
Yeah, that sounds good. So thank you, Harry Colvin from Longview Economics. I could link to your YouTube channel as well.
Brilliant.
Down in the description. Thank you very much. Have a really good Wednesday, everyone.